purchases and cash payments. The chapter I want to indicate has some information in it that you may have some quiz questions on, but we will not be covering, nor will you be tested on. And that is the information pertaining to the inventory system of perpetual. We're going to be doing a periodic inventory system for this class. So the instructions that I give you today will deal with that type of a system. And that's using the new account called purchases instead of using a merchandise inventory account. So again, we're using that system for this class. I can always tell those that have read the chapter but not paid attention in class because they will want to use the other system. And that's not what I want to see when you do your journal entries for the purchase of merchandise. So let's first talk about making purchases. And what purchases entails is merchandise intended for resale. Not the purchase of anything else, but merchandise intended for resale. So for example, if I was to buy equipment, would that be a purchases? No. It's only merchandise intended to sell, so it's the purpose of your business, whatever merchandise you're selling for a profit. Okay? The order in which this process is done in a business is the following. You're going to decide that you want to purchase something to sell. And you're going to submit a form called a purchase requisition or a purchase rec. That form gets submitted for approval with the information regarding the product. What kind of information would be on a purchase rec? The items you want to order, maybe the quantity, the price, all of that information would be on there. Once that is approved, that purchase rec is approved, then usually something called a purchase order is then issued. That gives permission to make the purchase of whatever merchandise it is you're wanting. So again, purchase order is then filled out. Now, once the purchase order, or often called PO, is filled out and submitted, then you just wait for the merchandise to either be delivered or you pick it up or whatever form you do for shipping. And then you're going to receive something called some type of an invoice or receiving order. What should you do whenever you receive a shipment of merchandise? Double check it according to, first of all, what you ordered on the purchase order. Make sure you're receiving what you ordered and make sure the prices are the same. That's just a sensible thing to do. The next thing is check it against what you actually receive. Make sure, again, you're receiving the amount and the items that you actually ordered. And make sure they're in good condition. So make sure there's nothing defective, broken, or missing. Okay, so that's the order you're going to do. Once everything has been checked off, then you can submit it to your accounting department or wherever for payment. But all of those should be followed. That protocol should be followed for all purchases. Now, what kind of an account is purchases? It's considered a cost account. It's the cost of doing business. So it's very similar in nature to something called expenses, but it comes under a different category called cost of goods sold, and we shorten it to just cost. So therefore, what type of balance do expenses have? Debit. So what kind of a balance do you think a cost account or purchases will have? A debit balance. So the purchases account will have a debit balance. So it's going to increase on the debit side. One more thing to add. And therefore, if it's a cost account, it needs to be included on the financial statement called income statement. Income statement. So we're not just going to list operating expenses now. We're going to have a new caption called cost of goods sold. And part of that is purchases. There's a lot more to it, but we'll be covering that in more detail when we get to chapters 11 and 12. Now, this part, however, is very similar to something we learned last time. You take the gross purchases that you have, and from it you're going to subtract two items very similar in nature to sales return and allowance and sales discounts, called purchases return and allowance and purchases discount. When you subtract both of those from the gross purchases, you arrive at something called net purchases. Now, purchases return and allowance, purchases discount. What kind of accounts do you think those are? Based on what you already know. If they're directly corresponding to purchases, what does that tell you they are? Good. They're contra and they're credit. They're contra because they're related to purchases. They have a negative effect on it. Therefore, they have the opposite balance, so they will be credits. So both purchases return and allowance and purchases discounts will have credit balances. Okay? Contra cost accounts. Contra cost, because purchases is a cost account, therefore purchases return and allowance and purchases discount are both contra cost accounts. So here's an example of a purchase order. Notice it's showing the vendor, who it's shipped to, etc. Take a good look at the terms because we've seen those before. And again, a review. What does 210 net 60 mean?
2% within the first 10 days.
Good. A 2% discount if paid within 10 days. And net is due in 60. Everyone clear still on that? Those terms are going to be the same. A new one, however, is the FOB shipping point. FOB shipping point. What does FOB stand for? From the chapter. Free on board. Free on board. So think about it. If shipping is free on board from the shipping point, who's paying for shipping? The buyer. If it says FOB destination, meaning it's free on board to the destination, who's paying for shipping? The seller, because they're paying for it all the way to the destination, which is to the buyer. So you have to pay attention as to who pays for shipping. Is that an important part of purchases? Yes, because shipping is a big expense anymore. So you want to pay attention as to who is paying the shipping when you're placing your orders. Okay, here's a source document showing what has been purchased and the total amount. From this, you would then record it. So let's take a look at this. You notice the unit price times the quantity, and that's how you go across. So you'll have people always checking that to make sure the math is correct. You see the freight added on because it's FOB shipping point, which means you're responsible for paying for this freight, and therefore the total amount due needs to be checked. And then you would then have to record it in your journal. So let's repeat those two freight charges that we talked about. FOB destination, again, seller pays for shipping charges. And FOB shipping point, buyer pays for shipping charges. Now, here's another new account we're going to talk about called Freight In. That literally is usually the name of it, Freight In. Now, this is a cost account, and therefore, remember what cost accounts have? Do they have debit or credit balances? Debit, similar to expenses. It has a debit balance. It's recorded on the income statement because, again, it's part of that cost of goods sold section. So it's an account called Freight In. It's whenever you have freight charges added to the invoice. Freight means shipping. Okay? In whatever method happens to be the case for it. Could be air, could be ground, could be truck, could be train, could be whatever. So let's take a look at a journal entry for a purchase of merchandise. First of all, the debit goes to purchases. Remember that cost account we talked about? Because there were freight charges associated with this purchase, we want to also debit Freight In. Remember, it's a cost account with a debit balance. And then the credit goes to, if it's on account, accounts payable. And any time you have accounts payable now in the journal, it's going to require a recording to the subsidiary ledger for accounts payable. They're going to have their own subsidiary ledger, which has all the vendors you're going to buy from. So therefore, you're going to need the name of that vendor also recorded. So look in the post-reference column for this. You're going to need to put a slash, which means you're going to post to accounts payable in the general ledger, and then you're going to go to the accounts payable subsidiary ledger and post to that vendor to update their account too. So at any point, you can tell how much you owe your vendors. And again, debits still equal credits for all transactions. Now, remember the accounts receivable subsidiary ledger? Again, the accounts payable subsidiary ledger is similar. It's just a listing instead of customers of all the vendors that you purchase merchandise from. Merchandise or other things. So you're going to have a listing of all of them and the balances in them. So every time you purchase something, you're going to record it to the appropriate vendor. And then every time you make a payment to these vendors, you're going to also record it to the subsidiary ledger. So at any point, you can see how much you owe any specific vendor. And again, the contra account, purchases, return, and allowance, always abbreviated purchases RNA, is a contra cost account. It therefore has a credit balance. And again, it's reported on the income statement. Recorded on the income statement. Now, again, a similar thing is going to be happening with purchases. Sometimes we're going to get products that we're going to return for various reasons. Could be defective in some way, could also just be we don't need them, maybe we over-ordered, anything like that. And that's going to require what's called a debit memorandum, which means we're going to return some of that product to the vendor, indicating a purchase, return, and allowance. Now, here's an example of a debit memo. Notice it just shows what's been returned. You always want to check that to make sure it's also correct, and that you've been given the appropriate credit according to how much you had to initially be charged for the product that was returned. Now, journalizing this transaction would require, first of all, accounts payable needs to be debited, which means it's going to be reducing the debt that you owe this vendor. What should follow that accounts payable? Remember, every time you have accounts payable in the journal, what must also follow that? A name. So the name of the vendor would also go there. And then if you put a slash in the post-reference column, that will remind you, I need to post to both places, both to the general ledger accounts payable and also to the accounts payable subsidiary ledger for that vendor, whoever it may be. And then the credit goes to purchases R&A. It's a contra purchase account, so it has a credit balance, so it makes sense that you would credit it here for the amount of the purchase return or the amount of the allowance given for the items returned. Now, just like we sometimes allow discounts to our customers, vendors will do the same. It's called purchases discount. It is again a contra cost account, therefore it has a credit balance, and it is also reported on the income statement. It reduces purchases, gross purchases, discounts. What are discounts given for? Payment, prompt payment. So whatever the terms happen to be, you can take advantage of that discount if you pay it within the terms of that discount. Is it worth getting such small percentages as 1 and 2%? Absolutely. Even though the volume could be low, think about if you add that up across all the merchandise that you get, you'd be surprised at how much that small percentage can save you in the end, by the end of the year. So it's wise to do, to take advantage of discounts. When would you not want to take advantage of a discount? Can you think of any situation where you may want to skip it? If you had a cash flow problem, maybe you didn't have a whole lot of money in the bank at this time when you're making this purchase, and you wouldn't have enough to cover the payment, so you're thinking, but if I wait a few more days, then I will. You may have to forego that discount because otherwise you might have taken out a loan or something in order to be able to pay it to get the discount, and that doesn't make sense. But otherwise, take advantage when possible of discounts. Okay, here's the payment of an invoice. First of all, again, accounts payable gets debited, reducing debt. You'd also have the company's name, the vendor's name right there. And then, do you pay them that full amount? Well, it depends on when you're paying. If you're paying within the discount period, you get to take the discount. Kind of like making a payment for a purchase at the store and using a coupon. What happens when you use that? You don't have to pay the amount shown. You have to pay a reduced amount. So the reduced amount will be the cash amount shown, and the discount will be the percentage given for paying by a certain time. And those two credits together should equal the total amount that you owe. So let's look at some journal entries here for some cash payment transactions. First one, if you're debiting prepaid insurance, what does that mean you're doing? Paying in advance for your insurance, which is often done, and you're paying cash for it. So a simple purchasing an asset here. The next one is what? If you're debiting accounts payable, are you increasing it or decreasing it? Debiting accounts payable. Decreasing it. So you're making a payment on account, and you're paying cash for it. So again, that's a payment of a liability or a debt that you owe. The next one, again, same thing, but this time we're paying a vendor, but we're paying within the discount period. So within whatever terms are given to us for being on account or for credit purchases. So Remember, the discount and the cash amount together equal the total amount that you owe. Discount and cash amount together equal the total amount that you owe. So always watch the balancing here. And look at the post reference here. What do you see? 211, which is what? Account number for? Accounts payable. And the check mark indicates? Good. You've recorded it in the accounts payable subsidiary ledger under Jones Corporation. Okay? And just like last chapter, we did a schedule of accounts receivable. This time, we're going to do a schedule of accounts payable. And what is that going to include? A list of all vendors and their balances. All vendors with balances only. If you don't owe a vendor, you don't have to list them on the schedule of accounts payable. Only those vendors with balances, or only those companies you owe money to. And here's an example of one. Again, company name goes in the heading, what it is, a schedule of accounts payable, and the date it was prepared. And again, you list your vendors and their balances as of this date. You total them up, and that total should agree with something. What should it agree with? Accounts payable in the general ledger. Accounts payable, therefore, is called a controlling account. It controls all those vendors listed in the accounts payable subsidiary ledger. The amount in accounts payable should equal the balance in all of the vendor accounts together. Therefore, that's why accounts payable is called a controlling account. If it's not correct, you need to go back to see where a mistake has been made, because something is incorrect. Now, I'm just going to briefly state this because it's in this chapter and you may have a couple quiz questions, but the system that we have shown you today, journalizing by doing purchases of merchandise, by debiting purchases, is a periodic system. That means that we're using the purchases account to show all new merchandise that we purchased during the year. That's a periodic system. What we're going to do then is update it periodically when we do financial statements to reflect what is left. But for the purposes of this class, you're going to use purchases only for the inventory system. The other system is perpetual, which constantly updates what's called your merchandise inventory. And we do not use that for this class, okay? So we're not using that system. Because every time you would purchase merchandise, you would do something like debit merchandise inventory. And then you'd have to do another transaction showing a cost of goods sold entry. But again, we're not using that for this class. If you take other accounting classes, you'll go into that system. But for this class, we're only doing the one system.